Do you see any unhealthy trends in valuation in the market today, the same way tech or housing was valued in the past?
Yes, I do, because the market extends the menu, extends what we call the capital market line, extends from what's called the risk-free rate. The risk-free rate is the rate, generally speaking, on the 30-day Treasury bill. And of course, if you can get 3% on the risk-free rate, then in order to tie up your money for 5 years, in a 5-year Treasury, you want 4, and to get it 10 years, you want 5. And if you can get 10 years on a government security, a 5%, then in order to go into a corporate security, which has some credit risk, you would demand 6. And to go into a high-yield bond, you demand 12, and so forth. So there's a kind of a process called equilibration, which makes things line up in terms of relative risk and return, but always pegged from the risk-free rate. Today, the risk-free rate is 0. So everything that I just named, this capital market line has had a parallel downward shift. And so before the crisis, I had, Saurabh mentioned about the fact that I turned bearish. All my money was in treasuries. All the money that I had outside of Oaktree was in treasuries. And I was getting 6.5% for 1, 2, 3, 4, 5, 6-year maturities. I was getting income and safety. Today, you have a choice, income or safety. Because the things today that are highly safe pay no income. And if you go to Fidelity, conduct an experiment. Go to Fidelity or Vanguard or a big mutual fund firm and go online and look at their menu of offerings and what is the current yield, the current net yield after fees and expenses. And you'll see that for money market and short-term treasuries and maybe intermediate-term treasuries, the yield is 0. So just think, the guy is watching the Super Bowl in his undershirt. He gets a statement from Fidelity. He opens it up, and it says, the yield on your fund is now 0. He grabs the phone. He calls the 800 number. He says, get me out of that fund that yields 0 and put me in the one that yields 6. And he becomes a high-yield bond investor. He has no idea why. He doesn't know what a high-yield bond is. He doesn't understand what the dangers are. He doesn't understand how to pick a high-yield bond manager. But he's seduced by that 6% versus 0. And all around the investment world today, people are chasing return. They don't like the low returns that are available on safe instruments. They're going for the gusto. They're going for riskier instruments, and they're doing it mindlessly. And I promised you I'd mention some memos. I forgot to do that. But if you go back, I wrote one in March of '07 called The Race to the Bottom. And I talked about the fact that when people are, number one, eager to invest, and number two, not sufficiently risk conscious, they do risky things. And when people do risky things, the market becomes a risky place. And that's why Buffett says, the less prudence with which others conduct our affairs, the greater the prudence with which we must conduct our own affairs. And that is going on now to some extent, because people can't get a good return from safe instruments. They're going into the risky ones, and they're bidding, So there's a race to the bottom.